Well, good afternoon, everybody. We're running a couple minutes late, but I'm glad that you're here. I hope you're tuned in. As you could probably guess, I am very excited for this week's episode. And this will be an interesting topic to discuss. And you might be wondering how we could devote an entire hour to cap rates. But I stumbled across this book by Brian Burke. I don't know if that's focusing on there. It's called The Hands-Off Investor. Brian is the CEO of Praxis Capital. They have about $200 million worth of assets under management. And in his book, which also parallels two awesome articles that I have in the description of this video, it talks about how there's a lot of misunderstandings and myths about cap rates. So we're going to talk about what cap rates are, what they aren't, what investment metrics people can use, and really just do a dive into one of these topics that people might not have a really good understanding about, or that they believe that they might have an understanding when there's actually some clarity that we need to unpack on this. So with that, Wyatt, if you could please bring in Brian. Brian, thanks so much for joining me on the call.
Thanks for having me here.
So I want to tee this off. We actually had a question come in early on this from LG. Thanks for the question in the comment here. Recent article in Investopedia says capitalization rates, cap rates, is used in commercial real estate to indicate the rate of return that is expected to be generated on an investment property. And this is Investopedia, which I think a lot of people would probably rely on to get information. It's particularly if they don't have any understanding or background in this topic. They might Google what is a cap rate. Investopedia is a popular website, so this comes up. The first thing that it says is that a cap rate is an investment return. What's your first reaction to that comment?
My first reaction to that comment is that anybody that ever says that, just they need to get out of the commercial real estate business, or maybe the media or reporting business, because they're just not reporting true facts. It has nothing to do with investment returns whatsoever.
So let's unpack that. And again, for people that want to explore this in even more detail than we're going to cover, you do have the book Hands-Off Investor, which is an awesome book. I want to get deep into the weeds on this though as well, and really get a firm understanding from you on what cap rates are, what they aren't, what they are used for. And then if we have time, we could even discuss what other metrics people can use to evaluate a return on a property. And I'd encourage anyone that has questions on this to just type it in the chat bar, because I think as we go through this discussion, I think that this will be eye-opening for a lot of people. And there might be some people that disagree with what you have to say. And I welcome that banter back and forth on this. I am solely in your camp after reading your book and your articles. But I think that there will be people that disagree with us on this, particularly as that one Investopedia author clearly disagrees with that already, if that was the opening line of his article. So let's start right at the basics, and then we'll dive into it deeper. What is a cap rate?
A cap rate is nothing more than just a thermometer that's indicating the temperature of the market. It's nothing more, it's nothing less. It's, by definition, by mathematical definition, cap rate is simply a function of taking the property's income and dividing it by its sales price to arrive at a percentage number. That's what cap rate is by mathematics. And people try to misuse that because, in math, you can alter the position of the variables, right? So that means that if you took the income and divided it by a cap rate, you would come up with a value. And that's where people go wrong in real estate, is they try to apply the cap rate formula by switching the variables and trying to determine the property's value by using its cap rate. And it's just an inappropriate method for valuing commercial real estate. And it results in a lot of people paying the wrong price.
So let's dive into that more, because I think that that's very common. I bet there's people tuned into this that would take that approach. They would see a property that has $100,000 worth of income. They would capitalize that and arrive at some value, as you're saying, in that mathematical triangle that they try to manipulate. So why is that incorrect?
Yeah, the quintessential $100,000 income with 10% cap rate means the property's worth $1 million. And then when somebody comes along and pays $2 million for it, they're like, those guys are crazy. What are they thinking paying $2 million? It's really only worth $1 million. But who came up with the 10% cap rate? Well, probably the person doing the calculation, right? And that's just, again, it's an inappropriate application of the cap rate formula. So the cap rate is only a barometer of or a thermometer of the market. So if you have $100,000 in income and the property sells for $2 million, the cap rate was 5%. That's all the information you get. Now, that isn't very enlightening unless, of course, you're buying a similar property and, it's got $100,000 worth of income and you're trying to figure out like, okay, if I pay $2 million, that's a 5% cap rate. How does that factor into the market overall? Is that what other people are paying? Am I paying too much or too little? And then you find that several other similar assets have also traded at a 5% cap rate. You feel better about yourself because you figure that you're probably paying about a market price. And so it's no different than if you're going out in the residential real estate world and looking for comparable sales. And you're trying to say like, okay, this house is this many square feet and it was built in this year with this size of a lot. And it's this many bedrooms and bathrooms. And therefore, there's 5 others that all sold for $250,000. So therefore, this property is worth $250,000. In the commercial real estate world, it's not that simple because no 2 apartment complexes are similar enough to be able to compare them directly in such a way, as well as other commercial real estate assets. You might have a commercial strip mall or a retail property that, is not going to be exactly like any other. So in order to try to compare apples to apples, you compare the value of each income stream. And the way that you compare the value of an income stream is to boil it down to a cap rate, because every income stream is different too, right? One probably makes 100 grand, one makes 125, another's 175. So the way you bake it down is you just simply divide the income by the price and you get a cap rate. And now you can compare that cap rate from one asset to the other. And again, feel better about yourself that you're paying a market price. That's it.
So why, in your opinion, has cap rates become the dominant metric that's used in commercial real estate? And you see this everywhere. You'll see a mainstream media quoting cap rates. You'll hear industry people talking about cap rates. It is probably the most talked about number in all of commercial real estate. So why has it become such a prominent figure to discuss, particularly when there's a lot of misunderstandings about it?
Because it's easy to measure. If you walk up to anybody on the street and you want to strike up a conversation, you might say, "Oh, it's a nice day today, right? It's about 85 degrees." I mean, everybody understands that language. Everybody understands it's 85 degrees. It's simple to measure. It's easy to talk about, and everybody quickly understands what you mean. So people use cap rate for that same reason. It's a number that people can say like, oh, properties are trading at a 5% cap rate. Okay, that's either good or bad. They have their preconceived opinion whether that's good or bad. Just like you and I might disagree on what a warm day is. To me, a warm day is 85 degrees. Then if you're in Canada or somewhere it's really cold and you're like, a warm day is 50. So it's the same thing with cap rates, where some people were like, oh, a 5% cap rate's a great deal, where other people are like, what are you talking about? I got to see a 8% cap rate or it's no good. But again, this is all just a matter of personal opinion, right?
So there's a couple specific examples that I want to get your thoughts on, and that is where, and I've heard numerous people describe a cap rate this way, is they call it the rate of return on an unleveraged investment. So they'll say a cap rate is essentially, because the NOI doesn't factor in any debt, so part of the equation is removing the debt. So they say that in theory, the cap rate is the unleveraged rate of return.
Yeah, or said another way, they say like the cap rate is the rate of return you'd receive if you paid all cash for the property,
Yes.
right? I mean, it's saying the same thing in 2 different ways, but I've heard it described both of those ways. But it's flat out untrue. Because first of all, let's say you buy a property for $1 million and it has $100,000 of income. You could say you're getting a 10% return, right? That's what the cap rate formula tells you. If you divide the $100,000 by the $1 million, you get 10%. So is 10% your unlevered rate of return, Chad?
Well, I would say no, because you're not looking at the property in a vacuum, and there's a lot more things to have to factor in.
You named it. I mean, that's just the issue. So first of all, you bought it for $1 million, but you had to pay $50,000 in closing costs for title insurance and, a variety of other things. So even if you paid all cash, you actually have more cash out of your pocket than the purchase price itself. So therefore, automatically, your 10% return is a 9.7 or something, right? Depending upon how much your closing costs were. Then again, if your property taxes get reassessed and go up because you just bought this property and the tax assessor assesses at a different rate, now your expenses just went up. So that means your return went down. Now, some would say, well, yeah, but you're going to use the tax adjusted, net operating income to calculate cap rate. And yes, that's the correct way to do it. But you'll find that oftentimes that's not the way some people are calculating the cap rate. So that's a whole other topic for us to discuss, maybe in a later question. But what the so-called unleveraged return doesn't quantify when applied in such a simple manner is all of the things that happen in conjunction with the purchase and following the purchase, such as let's say that you put $300,000 into upgrading units, or it's a retail center and you upgrade the facade and put in new signage and repave the parking lot. Or you put in new appliances in apartment units, or whatever the case may be. You put money into the property. Now you have more money out of pocket, which therefore reduces your rate of return. So the cap rate formula fails again to give you an unlevered return. And then you probably did that with the expectation that after having made those improvements, you would be able to increase rents. Otherwise, why do it? So, the rent that used to be $1,000 per apartment unit is now, $1,200 per apartment unit, or the retail rent that was $1 a square foot is now $1.20 a square foot. And after you factor in the income that you receive after you've made those improvements, the income went up, the cash out of pocket went up, and the relationship between the historical income and the purchase price that were used to calculate this phantom so-called 10% unlevered rate of return is completely out the window because all the variables have changed.
That was so very well said. And I do want to explore that part you brought up about just the variables, such as what is net income, what is the value, is it a market value, is it a tax assessed value? I want to explore that too. But the other question that I had first was related to what we're experiencing in the interest rate world right now, where there's upward pressure on interest rates. There's speculation the Feds might increase rates another 75 basis points at the end of the month. We're clearly in this environment of rising interest rates, which leads a lot of people to speculate that we should see a corresponding increase in cap rates. And you would dispel that notion as well.
Well, I would. I mean, a lot of people are under the impression that that cap rates and interest rates are twin siblings, when a more accurate description might be, second cousins. They're related to one another, but they share very, only a few pieces of DNA. Outside of that, they're unrelated to each other. There's a lot of factors that go into the valuation of commercial real estate. And one reason why interest rates may track in a completely different direction from cap rates is rent growth. And, right now we're seeing rent growth of 20% in some markets on an annual basis. And in some markets, many markets, it's over 10%. I think I studied 150 markets, and 100 markets out of the 150 I studied were forecasted to see greater than 10% rent growth in 2023. So when you factor in the rising income that's derived from just natural rent growth, that can override interest rate increases, either to some extent or totally, or even more so, where cap rates could even trend down in a rising interest rate environment. We've certainly seen that before. Now, that doesn't mean that when we see rising interest rates like we are now, which is, in the range of probably 2% or more on actual borrowing cost, that rent growth rate is going to completely overpower that. And you're going to see no increase in cap rate. You certainly will, but we're not seeing 2% increases in cap rate because there was a 2% increase in interest rate.
Yeah, it doesn't move in lockstep like a lot of people, pundits particularly, like that guy that wrote the article on Investopedia. I would speculate that he's not directly involved in commercial real estate, or I hope that he's not in a position where he's making decisions based on his limited knowledge on cap rates. But I think that leads naturally to how you use cap rates. So you've just described it very well. I think it's very clear to people that it's not a return metric. It's not tied to interest rates per se. There's overlap, but doesn't move in lockstep. How do you? And maybe we could even set this up that you're looking at a hypothetical property. Someone puts so this show is focused on industrial real estate, and I know you're focused on multifamily, but there's clearly a lot of overlap on how cap rates reflect multifamily or industrial. So I'll use it in your terms just to make so it's easier for you to understand and to explain to us. So let's say someone puts a 100-unit apartment building in front of you, and it's located in a market you know reasonably well. How do you go through the process of evaluating that deal? And I understand that you'd go through a full due diligence period where you're looking at a number of different things, but even it's just that back of the envelope math to see if it's something that you would want to explore further. And in there, if you could also explain how you would use the cap rate, if at all.
Yeah, well, first of all, back of the envelope doesn't really exist for me, because back of the envelope implies that there's a simple rule of thumb to use to evaluate whether a real estate deal is any good or not. And the simplest rule of thumb would be to use the cap rate to come up with a purchase price, which, as we've discussed, is the exact wrong thing to do. So that means that the simple way out is off the table. So instead, now you're stuck with a more complicated approach. And for me, that complicated approach means that we're going to look at what we believe rental rates will be for every year during our period that we plan to own the property. And we will calculate the income the property is going to throw off based upon that rental rate every year throughout that intended hold period. And then we evaluate the value of that income stream at the time that we plan to sell. And this is where cap rate comes in as a useful tool. And it's the only place cap rate comes in as a useful tool. When you're evaluating any real estate investment, there's two things you want to know. How much money can I make while I own it? And how much can I sell it for when it's time to sell it? Those are the two most important pieces of information you can use in your analysis. Now, how do you come up with how much can I sell it for when we go to sell it? How do you just make a price up? Well, what we use is where we use cap rate. We will try to make a guess, and that's exactly what this is. It's an educated guess on what the temperature of the market might look like at the time that we go to sell that asset. And that temperature is measured by cap rate, and therefore we'll use a cap rate to estimate a resale value. And we'll use the income that we projected in the year of the sale, and we'll divide that by the cap rate we project for that period of time to estimate a price that we can likely sell this asset for at that time. Now, how do you come up with such a guess? Well, we first start by looking at what's the condition of the market today and what are cap rates today. And this is, cap rates do have a purpose, and this is what it is. It's like, okay, everything is selling at a 4 cap, let's just say 4% cap rate. That seems to be market now for Class A and B multifamily assets. Probably industrial is just a niche higher. I don't know, 4.5, 5, depending on the market. So you figure out where your cap rate is now, and then you have to think to yourself, and this is where you have to disconnect yourself from the emotion of the market, because you have to think logically about what's the state of the market today. Is the market really super hot, or is it not so hot? Well, 3 months ago, you would say the market's really super hot and will never get any hotter. So that would indicate to me that when I'm projecting an exit cap rate 3, 4 to 5 years into the future, I'm going to assume the market is not going to be as good then as it is now. Therefore, I'm going to have to use a higher cap rate to estimate my resale value. On the other hand, in 2010, when we were buying assets and the market was in the toilet and everybody was like, oh, you're buying real estate, you're crazy. That's like catching a falling knife. What are you even thinking? We knew that real estate was probably not very desirable, and it was very likely that by the time we went to sell anything we were buying at that time, that the market would be better at the time we went to sell than it was at the time we were buying. Therefore, we could forecast that cap rates would go down and they'd be lower than they were at the time we were buying. So you just have to think about where the market is, look at what the market is today in cap rate, and then make a decision on where you think it's going to be in the future. And that gives you your basis for estimating your sale price.
When you're building your pro forma, do you typically have a set time in line? Like, do you have like a sunset clause that you're going to exit that market in 8 years, or do you do like an arbitrary 5 or 10-year projection?
We do a 10-year analysis and we project a sale price every year through that 10-year period. And so, because, obviously if we're assuming that rents are growing at a certain rate, and that we expect to renovate and get a specific value for that renovation by using comparable rental properties to see what they're renting for once they're improved to the level we intend to improve them. In order to get that annual income each year, we have to calculate that net income for every year of the 10-year hold period anyway. So then calculating an exit value for every year is a simple matter of, doing this market analysis to determine what the market might look like in those years, coming up with a value for every year. So we know approximately what we could sell that asset for every year during that 10-year analysis. And then it's simply a matter of making a decision of which year might be the best year to sell. Generally speaking, we're seeing that in year 3 to 5. Because we've made immediate improvements up front. We've added value to the property by fixing up units or what have you. And, we forced a lot of rent growth in the early period. And in the later period, it's up to organic market rent growth to take over, which usually is a lot less rent growth than you'll see by actually physically doing something. Meaning that we get a big jump in value early, and then you kind of trail up a little bit or incrementally past year 5. So, this is how we decide when we sell, is we just look at the numbers and see what the optimal exit point is.
So in your book, you did mention, and I think it's clear to everybody listening, cap rates are not a return metric, but you did mention that there are 3 return metrics that you typically rely on: net present value, internal rate of return, that discounted cash flow analysis, a cash on cash return, and then also an income multiplier. Or do you use those 3 in conjunction with your pro forma to arrive at the value that you're willing to pay for that property? And perhaps a 2-part question, if you could just even explain those for people that might not have a firm grasp on that.
Yeah, sure. So the 3 metrics you mentioned, internal rate of return, is just simply a matter of, if you think of like annualized return is the easiest way to think about it. Like, okay, if the property, if I bought it for $1 million and we're getting $100,000 of income every year, that's a 10% return, right? So if you did that every year, it's a 10% annualized return. That's what IRR kind of is. The only difference is it takes into account the exit value and the cash flow that you receive in the final year. It factors that in. It also figures out the timing of when those cash flows are received. And it also allows you to account for both incoming and outgoing cash flows, like, additional investments that might need to be made and so forth. So it's kind of like an annualized return, but better because it has a lot more inputs. So that's IRR, internal rate of return. The next one that we use is cash on cash return. This is just simply a measurement of how much cash you receive every year from operations. So again, your $1 million investment, 100,000 income is a 10% cash on cash return. Really simple to calculate. We calculate that 2 ways. We calculate it every year to see what each year's cash on cash return would be. And then we also calculate an average to see what the average over the lifespan of the investment would be. And then the last one is equity multiple. This is kind of like going to Las Vegas and putting a $100 bill on black. If you hit black, you've doubled your money. So that would be a 2.0 equity multiple. If you hit red, you get 0. That's a 0 equity multiple. If you went to Vegas and broke even, that's a 1.0 equity multiple. You put in $100 and you got $100 back, you made nothing. So, if the simplest way to say it is a 2.0 equity multiple means you doubled your money. So those are the 3 different metrics that we use. And the reason that we use all 3 of those metrics is because we want to show our passive investors what potential returns could look like in all 3 of those different ways, because investments mean different things to different people. Someone who's retired and living off income might care a lot about cash on cash return, and they're going to want to really focus on how much am I going to put in my bank account every single year because I'm going to live off of that. versus other investors who maybe have a W-2 job, they make good income, they just want to grow their investments. They might want to look at internal rate of return because, you know, they're going to compare that IRR to other investment alternatives that are presented to them to figure out what's going to be the right investment for them to grow their assets. And then the other one is equity multiple, is for those people who like to say, well, if I put in $100,000, how much would I expect to get back? Well, that's easy. If it's a 1.7 equity multiple, you'd get $170,000. So it's just a real easy way for the fictional $100,000 investor to figure out how much money in versus how much money out. So those are the reasons that we use those three multiples. And it also is how we set our purchase price. This is really how we value income real estate, is we look at what price will this investment produce those three investment metrics that will appeal to a set of investors that will get us to the point of actually funding this thing. So if it's $10 million and that gives us a 5% IRR, a 1% cash on cash, and a 1.1 equity multiple, I can almost guarantee that no one is going to invest in that. But if I could cut the price in half, and now the IRR is a 12 or a 13, and the cash on cash is a 5 or a 6, and the equity multiple over a 5-year hold is a 1.7, 1.8. We can get those funded all day long, and that's how we're going to make that's how we're going to value the purchase price that we're going to pay for that asset.
Yeah, that was very well explained. Thank you for that. And I guess that leads me to the question on what happens when you can't get those metrics. So we've been in a very hot market for better part of 5 years now. Multifamily is continuing to climb. Industrial's doing very well. What happens when you encounter a market where you just can't get the numbers that make sense? Do you pass and be patient, or do you say to your investors, this is the state of the market, these are the returns that are commensurate with what we have to pay?
Well, this is how people improve their golf games, because you get to go out and maybe you go play golf 3 or 4 days a week. You take a few beach vacations, maybe do all those trips around the world you've been planning but never had time for. That's a great time to do that kind of stuff, because otherwise you're just spinning your wheels. And I say this in jest, but it's partially true. Like I haven't bought anything in 7 months because the market just wasn't there. The prices were getting too out of control. And now I'm actually seeing, at least in the multifamily sector, I'm seeing falling prices, and I don't think they've fallen enough yet. So we're just waiting for that to play out. And we'll jump back in when the time is right. So now I'm actually going out and playing golf every once in a while, and and doing other things that aren't analyzing deals, because there's really no point to it. So that's one answer. The other answer is you reset your investors' expectations to what the market currently is. And here's an example. Back in 2010, 11, 12, in that time period, when we were out looking for investors, people were saying, I won't get out of bed unless I can get a 20% IRR. So, at first we were finding a few deals like that. But then after, a year or two, it wasn't that anymore. Now it was a 16 or 17, if we're being realistic. And so it was an educational process for the investors to say, look, guys, if you want to do anything, you're going to have to be willing to live with a 17% IRR. And they grumble and all that stuff, but eventually enough of them come around and you get a few deals done. And then next thing you know, a few years later, hey guys, 14 or 15 IRRs was really where the market's at. And this was all absolutely true. This was where the market was. Now we got to, fast forward to, 2011, and, 12 or 13 IRRs were pretty much where the market was. And a lot of investors understood that, and they were funding those deals. Well, if you get to where prices were heading, in January and February of this year, it's like, you're looking at 8 or 9 high single digit IRRs. And that's when you're at single digit IRRs, you're at very little cash on cash return. You're looking at maxing out coverage constrained debt to around 60 LTV. At 3% cap rates. That's a signal to me that it's time to take a step back. And we started selling, and we sold probably 75% of our portfolio at the top of the market, and now we're waiting for it to fall enough for us to jump back in.
Yeah, and you mentioned a few minutes ago that you were buying in 2010 when everyone thought you were crazy, and that turned out to be a brilliant decision. And now you're selling at what appears to be a somewhat of a peak, because I agree with you. There's a lot of pressures in the market right now. We have 8% inflation. We've got interest rates rising to try and combat that. There's talk about a looming recession, and I don't want it to sound doom and gloom. I'm still optimistic about the long-term prospects of the market and investing in general, as I'm sure you are, since you have an active fund that you're still looking to purchase things on. But what are you following in the next, call it short term? Are you looking for that next 2010 entrance period to start buying properties again, or what's your outlook for the short to medium term here?
Gosh, part of me really wishes I could see a 2008, 9, 10 repeat, because our business did tremendously well during that period, because we were buying stuff. I literally was buying stuff at prices that these properties had last traded for in the 1980s. I mean, we set prices back 20 to 30 years, and it was a great time to be buying real estate. I don't think we're going to see that again. The good news for real estate owners, maybe not the best news for people who want to start buying, if you haven't been buying, is that the fundamentals of the market are actually considerably sound. There's high demand for residential real estate. There's high demand for industrial real estate, perhaps retail and office to a lesser degree. But there's really solid fundamentals. Rent growth is real, and it's supported by good reason in a lot of markets. So I definitely do believe in the market. What I did see was there was becoming what I call an emotional premium for real estate. And that emotional premium was that there was a lot of people that found it easy to raise money, or had raised money and needed to deploy it, and didn't want to miss out on this escalating market, and everybody's all in. It's kind of like the dot-com bubble of the 2000s, when everybody was buying tech stocks. Well, now everybody was buying real estate, and it drove the price into the stratosphere, into the 3% cap rate range, just crazy pricing. That didn't make a lot of sense. That was fueled a lot by, bridge financing that was going to high leverage ratios. And, now reality is beginning to set in for some people, that interest rates are increasing and rate cap pricing has gone up. And, due to a variety of factors, it's getting more expensive to get your foot in the door. As well as rent growth is probably going to moderate to a degree, because it was easy to raise rents 20% on people who are getting 50% raises. But now they're not getting 50% raises, and yet the price of everything else in their life has gone up 50%. So that doesn't leave any slack for them to absorb huge rent increases for much longer. So for those reasons, there's a pullback in pricing. It's just really a removal of the emotional premium and returning to where prices should have been all along, if we're being realistic about, performance. So I think this is, today might not be the best time to buy, but that doesn't mean that it won't be a month from now. I mean, it just really depends on, how things continue to shake out. We're monitoring it very, very closely. We're anxious to get back in and start buying again, but I would rather be a week too late than a day too early.
Well, that's a great point. Without trying to go too far down a tangent on this, do you think the central bank can get ahead of inflation with their interest rate policy that they're adopting? And another two-part question: do they raise it too much and overcorrect?
Well, I'm certainly no expert at economics. I've managed to do really well at real estate by staying in my lane, so it's hard for me to prognosticate on the effectivity of the central banking system. But I think that there's a lot of forces at play, and they only have so many strings to pull on. And I don't know if there's going to be enough strings to overcome some of the factors that are at play. And I think inflation is is probably spun out of control for a while, and we're probably going to see more of it. And now, of course, real estate buyers, especially ones that are trying to get people to invest in their acquisitions, are using the tagline that this inflation is good because when prices are going up, that means rents are going up and real estate is going up, and therefore your investment's going to do really well. And while that argument does have some merit, at a time like this when inflation has been around a while and sticks around a while, it will hurt rental property owners ultimately at some point, because the residents aren't going to have the disposable income to absorb continued rent growth forever. They could do it when their wages are going up and nothing else was going up, but now everything else is catching up. A pound of bacon is a lot more expensive than it used to be. Everybody knows about the price of gas, and that's a drain on everyone's wallet. And that means when the landlord comes to them, wants $100 rent increase, you get to a breaking point. And we may see that happen here in the not too distant future.
I want to explore that a little bit more with you, because I think you bring up a great point of differentiating between an active real estate investor and a passive real estate investor. And circling back to your book, that's really what it is. It's a guide for people that want to invest in syndications on a passive role. And I think people that tune into this show have a pretty good idea of both the opportunities and risks and perils of active real estate investing, but a lot of people might not be familiar with the passive route. So if you could you just describe what that looks like as a sponsor of a deal, and what that would look like for somebody that wants to invest passively?
Yeah, passive real estate investment is a vehicle where you have an investment sponsor who's an active real estate investor, who arranges debt to buy a property, and then for the equity component of that purchase, reaches out to a number of individuals or other organizations to provide equity capital for that acquisition. And those equity investors are passive investors. So instead of, if you're on the passive investor side, instead of taking money out of your wallet and sending it to an escrow company so you can buy a property, instead you're sending it to an investment sponsor who will then in turn couple that money up with money from others generally, and then send the collective pot to the escrow company to acquire the property as a group. And then that investment sponsor will manage the asset. They'll make the decisions on, when to refinance and sell and upgrade and how to spend the money. And they'll make sure that the investment or the expenses are paid. They'll manage the property manager and so on. And then when they ultimately sell the asset, they distribute the profits of that sale back out to the passive investors. So there's as far as like the risks of real estate investing, there's a lot of parallels between active investing and passive investing, because you're still doing the same thing. You're buying real estate and hoping to make a profit. The only difference is when you're investing passively, you have one additional risk factor, and that additional risk factor is the person that's in charge of the deal. Who's the group that's buying the property that is the investment sponsor? You just have to vet them very carefully and make sure that you've done your homework and due diligence on that sponsor. That's what's key.
I'm guessing I know the answer to this, but how many sponsor packages go out, prospectuses that say that a cap rate is a yield or rate of return? I'm guessing that's probably a red flag that they might not be the best sponsor to choose.
If anybody said that in their real estate prospectus and wanted me to invest in it, that would immediately go in the trash, because it just tells me that they don't understand at a very, very granular level how the numbers work. And as an investment sponsor, there's nothing more important than understanding very deeply how these numbers work. And how each of these things relate to one another. And if they don't have a grasp on that, then I'd question what other shortcomings they might have.
If you're up for it at some point down the road, it might even be worth doing a part 2 on this, where we just dive into the syndication model a little bit more and touch on, because we just touched on one chapter of your book with cap rates, but you offer quite a bit of value in there. It might even be worth, just for people that want to look into passive investing in real estate. I think there's a number of questions you can ask. Is how do you evaluate what's a good package? How do you evaluate what's a good property? the team behind it. I think there's a lot of things that we could explore on that. So if you're open to that sometime down the road, you said you have a little bit more time right now with golfing. Maybe you have a little bit more time for a second podcast interview as well, but we could talk about that later. I want to circle back to the point that we were talking about earlier with cap rates and how some of these numbers are even calculated. So I think we could start with net operating income, or NOI. There's a lot of different ways you could actually calculate NOI on what's included, what's not included, whether it's a stabilized NOI or it's a projected NOI. I think that also leads into a lot of the complexity that just comes with commercial real estate investing as well. What is your standard method of analyzing NOI in a deal?
Well, in the beginning of this show, you asked me a question about why are cap rates used so much? Why is it so prolific in the industry? And this is the reason why, another reason why cap rates are so prolific, in addition to just being easy to measure, is they're easy to manipulate. I created a model where I was able to figure out 32 different ways to measure cap rate on the same property. And 32. Each of those calculation methods would result in 32 different cap rates. So, the reason that cap rates are so popular is because a broker can figure out how to quote the cap rate most advantageous to achieving a sale. And of course, the buyer is going to figure out a cap rate that's the most advantageous to getting the lowest price. And, then the rest of it is a negotiation to figure out where this property actually trades, right? So there's a lot of ways to calculate it. And my favorite way, and really what I believe is the accurate method of telling me the information that cap rate is intended to tell, which is what is the state of the market? What's the temperature of the market? And that's to use the trailing 3-month income, which is the last 3 months of income the property has produced, annualized, which means you take that trailing 3 months worth of income and you multiply it by 4. That would tell you what the annual income is of the property based upon a snapshot of how it's performing today. Because if rent growth is high, the rents that they got 11 months ago might not accurately reflect a picture of how the property is performing today and how it might perform tomorrow. It's too far into the history book. So I take trailing 3 income annualized, and from that I subtract trailing 12-month expenses. Now the trailing 12-month expenses is because it's, as I just said, income doesn't matter 11 months ago, but expenses do. Expenses do because things like water bills, for example, are very seasonal. In some markets, you're watering the lawns in the summertime, but not in the wintertime. So, you've got to get a snapshot of the whole year's worth of expenses, not just one short, small period of time, because they're variable. So it's trailing 3-month income annualized minus an entire year's worth of expenses, the last 12 months of expenses. But before you can calculate those expenses for the year, you have to first adjust the property taxes. So what you do is you remove the property taxes from the calculation. You recalculate what the property taxes will be after you buy the property, and then you reinsert those back into the calculation by subtracting that from the income. So what this is called it's called a tax-adjusted T3/T12 income analysis. That's how I value income real estate's cap rate, or how I evaluate income real estate cap rates.
Yeah, that's crazy that there's 32 different ways of analyzing a cap rate. And I think that really highlights just how much variability there is in what cap rates are even quoted, because you have to think that there's very unlikely that two properties are going to go through that exact same methodology of arriving at their cap rates that perhaps get quoted in a market report, or some investor says, well, this property across the street just sold at a 5 cap. Well, did it? Like, how was that?
What
actually,
5 cap?
Yeah, what 5 cap? Like, I think that just really reinforces how much misunderstanding there is about cap rates, because there's so much that goes into it, and there's so much ways to manipulate it. I think that was very well said on that. And I just saw that a question just came in, which I think is relevant to this as well. Thanks for joining in. Thanks for the question. Which software tool would you use if not your own custom software? And just before you answer that, Brian, I think this is a great question, because there's a lot of different options out there for people. They can pay tons of money and they can get like a sophisticated model like Argus, all the way down to someone that just creates an Excel spreadsheet, and there's everything in between on that. So what do you use, and what do you recommend others to check out?
Yeah, I've been doing this a very, very long time. And when I started in this business, there was really no tool out there. There was one tool that was fairly good, put out by Real Data, and that I actually bought that program and used it for a little while early on, and then realized it didn't quite work exactly the way I wanted. So I realized early on in this business that the only way to really do this is to create your own model, because you know exactly what you want and what you need it to do and how you think and how you work. And not a lot of people think the way I think. So it was really important for me to create my own software for use of analysis of real estate. So, but since then, other companies have come on board that have started to produce, a decent product that I think is good for people to use as a starting point when they either don't know how to develop their own software, don't want to, or just want to start with something that gets them out of the gate quickly without having to go through years and years of iteration of making your own model. So Real Data, their product is still available, and they're on version, I don't even know what. And, it's been evolved over the years. I've seen one from, I think it's called REFM, Real Estate something or other, but I think getrefm.com. There's
the Peter Linneman one, right?
Yeah, I think that's right. And then there's another one, Adventures in CRE.com, I think is what it's called. And they've got a lot of different models that are actually quite sophisticated. I haven't seen them all, but I've seen a couple of them and they look kind of interesting. You mentioned Argus, which is like some of the ones that some of the institutional guys are using. So there's a number of different ones. And I think if you look at modeling software, you search for that, you're going to find a number of companies that are offering it. And it's just a matter of maybe getting trial versions or whatever and testing them out to see what one seems to fit you the best.
Yeah, that's good advice, because everyone is going to offer something different. There's going to be different back-end support if you need it. There's going to be additional costs if you want to keep going. There could be ones that is a standalone product that you buy once, and then there's going to be another one where you pay a yearly subscription. So they all vary in some regard. I recommend Peter Linneman. So they put out a course as well, which for people that want to learn more about real estate finance in general, he does a really good job of that. And I haven't looked into any of their software itself, but Peter Linneman is one of my favorite guys in real estate. So I'd recommend that, getrefm.com. And we'll try to put links to those other ones that you mentioned in there as well, Brian. Still have time for a couple questions if anyone wants to ask a question for Brian. Absolutely. Another question. Thanks for that. Which key variables you look at to forecast rent growth?
Well, the first thing I look at is population movement trends. And, we tend to invest in markets where people are moving to and avoid markets where people are moving from. So I'm looking at, largest population movement metros right now. You got like Phoenix, Tampa, Houston has been a good one. Just like where are people moving to? That's the first one that I look at. But I really also lean on some of the experts in this field. We get data from Axiometrics that, they have experts that spend all their time just entrenched in submarkets and looking at rent data and making forecasts of future rent growth. CoStar does it as well. Reese is another. All these are paid services and none of them are cheap. But, you get what you pay for.
Yeah, I could echo that as well. We subscribe to a few of those that you mentioned, and they're not cheap, but it is good value in there. And on that population growth side as well, I'm a big believer that that's what fuels a lot of the industrial growth too. So not only is there the people moving there need housing, but then they have shopping and they've got habits where they order stuff online or they go to a store, and that requires warehouse space. So I'm a big believer in that as well, and that's why I'm bullish on Texas and Florida in general. I think that there's going to be a lot of population migration continuing to go into those markets, and that's going to fuel industrial growth for the foreseeable future as well. So I want to wrap up there unless anyone has a last minute question, but I guess I wanted to get your closing comments on this, trying to bring everything back full circle and wrap it up with a nice bow on it. What would you say? How would you describe what cap rates are, what they're not, and what people should be using instead if you were to try and do that in like a minute? And you could take longer if you want to.
I'll try not to. I would say, cap rates are nothing more than a thermometer to give you the temperature reading of the current market. They're not a measurement of investment performance in any way whatsoever. And it's certainly not a measurement of any kind of rate of return. The metrics that I prefer to use: internal rate of return, cash on cash return, and equity multiple. Those are the three most important measurements for you to take in investing in real estate. And you can set the prices that you're willing to pay for any piece of real estate based upon the calculated returns that you'll achieve, because that's what this is. This is an investment. You're doing it to get a return. Quantify that, what that return is, and you just simply slide the price up and down until it results in a return that you're happy with. That's the way you do it.
That was probably like 30 seconds. That was perfect. We'll use that as a soundbite for sure, because you said you packed so much information into that. So I really do appreciate that. I'll wrap up with that. I just do want to encourage people. I don't know if that focuses or not. Hands Off Investor by Brian Burke. Fantastic book. Goes into a lot more detail about cap rates. Also just goes into a lot more detail about real estate investing in general. So I'd encourage you to check that out. We also put links to your LinkedIn as well as Praxis Capital's website in the description if people want to consider investing with you. And lastly, if you got any value from this, please hit that thumbs up button. It means a lot. And Brian, thank you so much for joining me on this call. Really do appreciate your wisdom.
Thanks for having me here. Look forward to next time for part 2.
Absolutely. We'll do that in the fall. Okay, thanks.